Joining me now is Annatjie Van Rooyen from Regenesys Business School to give us her take on the market's activity. Annatjie, thanks so much for your time this afternoon. So we're all watching those trade negotiations closely, and the tit for tat seems to still be playing out between China and the US. And I think we spoke about it last week. Jitters around the trade truce hit markets on Friday and into the new week. It still seems like the two can't really reach an agreement. It does seem like markets are shrugging this off. Are we just now waiting for certainty when it comes to these negotiations before making really big moves?
First of all, good afternoon, and thank you for having me. Yes, you are 100% right, but there's a few catalysts that's driving the market today. So first of all, I think the South African market continues to be underpinned by the tailwind of the Reserve Bank resuming that interest rate cutting cycle and that dovish pivoting statement that they delivered. Another tailwind is represented by the S&P Global South African Purchasing Managers Index, which was released earlier today, and that came in at 50.8 for May versus 50 in April. So this indicates growth for the first time since November 2024. So despite the positive domestic outlook, export orders continue to decline, but at a slower pace at least than in April, partly due to the US tariffs that's impacting foreign trade. And of course, these tariffs are also impacting the confidence numbers. But these PMI results actually indicate a strong second quarter performance for the private sector, with input price inflation moderating and allowing firms to reduce their selling prices. The trade talks we're expecting to continue later this week. We expect the presidents of the US and China to meet. So at least that de-escalation is still underpinning the markets and bringing stability. That 90-day pause is still in place. But as you have mentioned, the steel tariffs, unfortunately, will go up to 50%. The other thing that we're waiting is the NFP numbers on Friday. And if those prove that the jobs market still is resilient, and with this bond market stability, we might just see the Fed moving in June or July with their cutting cycle continuing with that. So I think that's what's giving markets the positive undertone.
All right. You touched on some local economic data, the PMI numbers coming out positively. On the other side, we have business confidence numbers coming out negatively, declining 40 points. Just yesterday, we saw that GDP print growth of 0.1%, pretty much the economy really flatlining. Just your analysis on the business confidence print and what it spells out for sentiment.
Yeah, I've said previously, there's quite a discrepancy between hard numbers and soft numbers. So that's more in the US, I suppose more applicable to the US economy than to the South African economy. But our hard numbers are not that great. But you referred to the GDP numbers yesterday, and although it was disappointing, it was better than expected. And I think with the improvement in electricity generation and the improvement that we are seeing in the transport and logistics sectors, we will see a gradual improvement in sentiment. So I know you've mentioned earlier that the sentiment numbers weren't looking great, but if you look at the PMI numbers, I think the market's taking comfort from the PMI numbers. So I think all in all, with the PMI numbers signaling a better second quarter, it will filter through to the confidence number at the later stage.
All right, let's look at some company news out today. 91 has been boosted by a better second half performance, and that's driving growth with assets under management gaining 4% during the full year period. Your analysis on those numbers?
Yes, the assets under management increased by 4% despite net outflows of 4.9 billion for the full year. Most of the outflows occurred in the first half, but the second half saw a small return to net inflows. Their adjusted earnings per share dropped by 3%, which was better than expected. Operating profit margin held firm at 31.2%. So by asset class, alternative investments in South Africa on the South African fund platform performed well, while their equities and their fixed income saw big outflows. Also, the highest outflows were from the UK, but the investment performance improved by 68% of strategies beating their benchmarks over 1 year and 81% over 10 years. So that's really impressive. Strong management, strong track records.
All right, let's look at SPAR, right? They reported a slight decline in revenue, or rather slight decline in earnings, while revenue was pretty flat. The group, however, says it is making strides with streamlining its operations. Both AWG as well as SPAR Switzerland are up for sale. Is this a turnaround story you believe in?
Yes, I think it's going to take time, but I do believe in it. So it's obviously those discontinued operations that had a very negative effect on the profitability of the group. And they have identified key objectives and they've already been able to achieve 3 of the 5 objectives. So I do think longer term it is a recovery story in Tallinn.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on some counters that have been attracting interest from your industry peers.
So my stock pick, I have picked it a while ago, but I still think it offers value. It's TSMC, Taiwan Semiconductor. I think based on Microsoft, Google, Meta's results, what we see in China, what we've seen from NVIDIA, very much the AI investment cycle is far from over. The demand for NVIDIA's products and other products similarly continues to grow and is structural in nature. And of course, there is no NVIDIA chip without TSMC. They are the ones who are making the cutting edge chips. They are the cheapest entry into the space, into the semiconductors at the most cutting edge. And they're trading at around 15 times next year's earnings. So for me, that remains a high quality cyclical play into the AI space. And that's my pick, TSMC.
I'm finding opportunity in a local share, HCI, Hoskin Consolidated Investments. I had a look. I also picked it a year ago, and it's down 17% over the past years in RD. So that just proves that my picks over a one-year basis are not good. But I'm sticking with HCI because I do like it for the long term. It's an investment holding company, good capital allocation by the people in charge, mostly Johnny Copland. And if you look at what they own a big slug of Tsogo Gaming. That's the one part of the business that did not do well over the past year. Physical casinos are under pressure relative to online gambling. They also have a coal business, which was the other negative detractor from performance over the past year. But then they have a few real gems. And one of the strongest performers the last year was Southern Sun, which is also separately listed, the hotel business. Then they have Deneb, they have Frontier Transport, they have eMedia, and then offshore, they own a large chunk of African Oil Corporation, which owns some gas rights on the southern South African coast. And they also own a big chunk of Impact Oil and Gas, which has got some oil fields off the coast of Namibia, which they de-risked in the last year. So if you add up all the assets, you can get to the current share price just by looking at the listed assets, which means you're getting the oil and gas exposure for free. Or if you put a value on the oil and gas assets, you can say that it's trading at a significant discount to its net asset value. Depending on your valuations, could be as much as 40 to 50% discount. So I like that.
So JP going with HCI and Grant picking TSMC. Are these counters you're liking?
Yes, I actually agree with both of them because, it makes a lot of sense in the case of HCI. The fact that that price is down 17% already gives you a much larger discount to NAV. And if you calculate the current sum of the parts, then the share does offer value at these levels due to the discount to NAV. Always a good investment to go for stocks with a decent discount to the NAV. And then in the case of TSMC, it's all about the AI story and the tech story, whether you still believe it. And I do think that there's still very good demand for that. And I think that dip in the tech sector was a nice buying opportunity. The CEO of the company also recently commented that the company faces limited impact from tariffs at this point in time. And he reaffirmed that AI demand remains strong and that he also at the same time guided for record earnings. So for those reasons, I agree with both of these.
All right. So you like those counters, but they are not your stock pick. What are you hanging your hat on today?
I was looking at the SPAR results and then I thought, you know what, ShopRite's just in a different league. So I'm going to go with ShopRite because they have control over distribution from which they extract supply chain efficiency. they also get more control from quality and service perspective. They operationally sound with a strong balance sheet. They're a market leader in the South African formal retail sector. They have a successful online and on-demand shopping platform with 60/60 remaining exciting in terms of their growth prospects. So I'm going to go with Shoprite.
Annatjie, let's leave it there. Thanks so much for joining us this afternoon. That was Annatjie Van Rooyen from Regenesys Business School.